Good morning, Stuart. How you doing today?
I'm doing great. How are you doing today, Ryan?
Doing really good. I'm super excited for today because I got your book in part of my soul searching after the aftermath of us selling our company, and your book is called Expensive Mistakes. And I want to, for the listener's sake, if you can go back, you've got many decades of experience in the M&A space, but can you kind of give the general backdrop of your experience and what advice and what type of clients you normally work with?
Sure. Well, I spent 7 years in the what was formerly the Big Eight, now I guess the Big Four, five of which in their national office, where I started their tax application software group and worked with early incarnations of the PC to do early spreadsheet analysis. Left there and spent the better part of went to work for a large firm in DC and spent the better part in 1987, 88, spent the better part of 2 years buying failing S&Ls and banks down in Texas when the S&L crisis hit. That was probably my first major foray into it, and then went to a boutique securities firm where I worked with small and mid-sized clients on capital raising, putting together business plans for financing, etc. Then spent a chunk of time with a mid-sized firm doing mergers and acquisitions and estate planning, and the intertwine between estate planning and sale of business is something that's commonly missed between people. And have met Dick Stiglitz, my co-author, in a men's communications group, and we decided to write the book basically as a give back to small and mid-sized companies who would not be exposed to the issues that his experience and my experience over the last 30 years had come together. And it was published initially in January of 2010, which is the first year that the baby boomers started hitting 65.
Well, and when I was reading it, and I was like, well, yep, I can relate because most of the listeners may or may not know of my show that my dad and I, when we sold, there was some things that we could have done that would have saved us almost $1.6 million. And I want to get into that because I think that touches in a couple of the different mistakes. And you've got like a total of 57 in this book. And I want to go back to when you and Dick were starting to write this book. Did you start with how many mistakes that are possible, or like where did kind of the book come into fruition?
I think the book came into fruition. We sat around a table for a while and started thinking about what we viewed as segregating the book into five main areas, which is from the seller side, developing your business and getting it ready for the sale, the buyer side on the same token, then looking at a transaction from the buyer side and the seller side, and finally the one that I think gets ignored significantly is the integration, because closing is not necessarily success in a deal if you are an acquirer. Mm-hmm. The integration piece, I've seen many deals fall apart for failure to integrate properly. And then we started we sort of put together, talking about common things that he and I had seen. And, we had probably more than the 57, but I think we tried to look at the ones that we thought would be most valuable to the small, mid-sized business owners that were more on a practical side. I think the book tries to look at things from a practical perspective, not just a legal, accounting, or business perspective, but what are the practical considerations you need to look at?
Well, yeah, and I loved it, and I wish I would have read it prior to us selling, because I mean, like, you only do it once usually if you're a business owner, and there are the serial entrepreneurs out there that'll continue to do it, but for the general population of entrepreneurs, that's their one big asset that they end up selling, and they don't know the mistakes until afterwards, like I alluded to in our situation. So there's a couple of the mistakes that I want to highlight and kind of dive in on your thoughts, but before we even get into the narrow subjects of a specific mistake, when you're working on the buy side, sell side with these entrepreneurs, is there a way that you can kind of summarize the main problem or strategy, or the lack of strategy in this whole situation?
Okay, well, you've hit on the sell side. It's real easy. It's lack of a plan.
Yeah.
It's a failure to plan, and that's where the integration comes in, is the failure to plan. One, what's your target? What's your real number? Most entrepreneurs many entrepreneurs have an inflated view of the value of their business, but they also don't necessarily understand how that business integrates in their overall financial plan. So it's really key in my mind that you figure that out. And secondly is, what are you going to do when you do sell the business? I think that is probably an area where, because as an example with Dick, he knew he could not continue to work for the business post, because it was his baby, and he knew himself well enough to know that he would only be frustrated watching someone else handling his baby going forward. So I think another major issue that this on the sell side is, can you stay with the company? Should you stay with the company going forward? And if you're not staying with the company, what are you going to do with the rest of your life? Because I've seen some very bad situations come up that people just, don't really have a personal plan post-acquisition. On the buy side, I think overestimation of how quickly you're going to be able to integrate, failure to necessarily understand the cultural issues that you may have if you're acquiring it if the acquirer is going to then put it in with an existing business. The cultural issues are I've seen major disasters in that area. So those probably are the two significant sets that I would see.
Yeah, and I think you touched on a couple big key points too, because it's just really having an awareness of all this and what are the different variables, which I think you guys spelled out pretty in a lot of detail in your book. And the first of the exit, or of the mistakes that I wanted to dive into, which you kind of just touched on, which is the vague exit strategy. And you talked about, and before we go into it, you had mentioned that can you stay with the business, can you not? And I think the vague exit strategy includes a lot of different things. And so if you can kind of say, when you say vague exit strategy, is it timing, the exit options? What do you mean when you say that?
Okay, well, vague exit strategy is one. If you're exiting, are you going to be financially secure for the rest of your life? And that is why the first thing, if I start working with a client, before I get handed an LOI, which is not the way I would prefer to work, but if I actually can develop a plan, the first thing I want the client to do is to meet with a financial planner or their financial planner and run a Monte Carlo analysis. And for those who don't know what a Monte Carlo analysis is, it is an analysis that most brokerage houses can run that says, based on you providing them your income and expenses, they can tell you how much capital you need for the remainder of your life with a 90 to 95% certainty. So the first question is to find out what the value, what you need to retire comfortably or to do the next deal or whatever that is. Mm-hmm. Secondly is then you can then look and do a real value of the business. And then you can compare the two. If it's a positive delta, meaning that the value of your business exceeds what you need, then you can do a lot of sophisticated planning in the tax area with regard to transferring to subsequent generations and charitable remainder trust and other types of vehicles where you can reduce the tax liability on the eventual sale. In one case recently, I had a client who found out that he had $1 million positive delta, and his view was that instead of selling it to a third party where he would have gotten that $1 million, he was more interested in allowing his management to buy it because they would have had trouble meeting what he thought his number needed to be. When he found out his number was lower, he could then sell it to his employees and preserve the legacy that he wanted to preserve. So knowing what you need and then knowing what the true value of the business as a starting point is important. Then we can look at, especially if we have time, how do we add value to the business? Have we golden handcuffed the employees? And one of the things that I think that many people miss today when they talk about golden handcuffing of employees is that, yes, you want to golden handcuff the employees to grow the value of the business. That's a wonderful thing. But if all of a sudden your top sales guy gets a big check the day of closing, what's the likelihood he is going to stay? So the idea here is that building a golden handcuff strategy that effectively creates a stay bonus for your key employees. Because if you can deliver an intact management team for 12 to 24 months post-acquisition, you will add anywhere from 25 to 100 basis points to your EBITDA multiplier. And so looking at how you can golden handcuff your employees and how to make it a win-win for them. Looking at things like, are you a mile wide and an inch deep, which would make your acquisition issues? Are you in my area in Washington, we have a lot of government contractors, and in the government contracting range, do you have full and open contracts, or are they set-asides based on particular status that you have, which is going to affect the value of the business? So by looking at those things, then we can look at how we can increase the value of the business. I work on a simple philosophy of that business is like a three-legged stool. There's the accounting and finance, there's the sales and marketing, and there's product delivery. All entrepreneurs start by doing all three. The smart ones figure out what they're not good at, or what they're not as good at, or what they don't want to do, and they bring in either a key employee or partner to handle those things to balance out the value of the business. Mm-hmm. So looking at those areas.
Yeah, and I love how you touched on a couple really good things about. I think there's a constant challenge behind how do you actually structure the deals with key executives, and how do you get them. Just writing a check is usually not aligning them with incentives and everything, and that's part of. So we follow the Value Builder system by John Warlow. I'm not sure if you're familiar with that or not, but he's got the 8 key drivers, and this whole concept of value building, I think, is newer in the last few years because it's a conscious effort to increase, like you had said, that multiplier on your pre-tax or your EBITDA. And so if you've got a delta or even a positive delta, you've got the ability to increase the value of your company. But then there's also ways that you can increase your net proceeds. So to kind of go back to when you were talking about how you structure everything, where the net proceeds is what you're concerned about, and cash flow. And so
correct.
You've got the multiplier and the value of the company, which is your gross dollar amount, but how that turns into your actual, proceeds is two different kind of things. So
yes.
I don't know if we can separate those and how you distinguish the two, or the different things that you advise people on how to approach it from both sides.
there are probably a couple of different things. One of the things that I look at is the idea of tying your employees in has to be a win-win. And in order to make it a win-win, you've got to make it that hopefully that the value of locking these key employees up in the company will increase your sales proceeds by more than what you're giving away to them.
Mm-hmm.
And I think that some people don't really necessarily look at how that plays in. And that's why, as I said, the idea of saying, okay, I'm going to sell the company and you're going to have your stock options and you're going to get ordinary income and nothing to lock you in post. Yes, you've helped me build the value of the business, but you haven't necessarily added to your EBITDA multiplier. Mm-hmm. And the way to add to the EBITDA multiplier is the idea is that creating payouts, as an example that I typically use, would be that you might, with LLCs or C Corps, because you can have multiple classes of equity, you create a employee class equity which has vesting valuation, because equity in a private company is basically wallpaper until a change in control. Mm-hmm. So the idea of creating something that says you actually own this equity, but if you leave, you're only going to get bought out on a portion of it based on how long you've been there. Mm-hmm. But the other thing that I think is key about why I like the equity piece, Ryan, is the idea is that I don't believe in necessarily giving equity. I like the idea of saying to an employee, you're going to buy the equity out of after-tax bonuses that I'm going to pay you. Mm-hmm. And the reason why I want to do that is that there are two types of employees in the world. There are those who are there for a paycheck, and there are those who have some entrepreneurial spirit. And if someone is unwilling to forego the opportunity cost of the bonus versus actually buying your equity, then they are probably not the right person in your management team, because they're there for a paycheck, not to help you grow the business.
Right. They see that paycheck as a missing boat if they buy the equity.
Exactly. But if they're not, and therefore, so it's a way to test. But then saying to them, well, with this equity class, you're going to get 10 or 15% of that as a capital gain rather than ordinary income. So the point is that I'm also, by having you buy this, I'm saving you 20% or more in taxes when you sell the company.
Yep.
When I sell the company, the employee now doesn't have ordinary income; they get capital gains. So, in exchange for that, it says you're going to get 10, 15, 20% at closing. You're going to get, let's say, 50 or 60% at the earlier of 1 year after acquisition, or 30 days after constructive termination. So if they mess around and try to transfer you, if they try to cut your salary, you get paid. But the employee, basically it says, as long as the new acquirer comes in and doesn't mess with your compensation or your duties, etc., you're going to stay a year. Now, the last piece of this is something else that people, in my opinion, tend to miss, and that is I put a portion to a funded covenant not to compete. Because a covenant not to compete is a license to sue. It is not anything else. But if all of a sudden I'm saying that the dovetail portion of 10 or 20% is going to be paid out on a monthly basis starting in month 13 after acquisition, as long as you don't compete. But if you do compete, the money gets paid into escrow, and the employee has a choice of saying, I'm going to forfeit it because I am competing, or suing and saying, no, I'm not competing, and since the agreement provides prevailing parties gets their fees paid, it keeps both sides honest, but you've also now delivered and locked up your management team for the acquirer for 2 years, which will maximize, which I believe will significantly maximize your multiplier when someone comes in.
It's because I like the word transferable value. It's how easy with the least amount of risk can someone come in and take over your operations. And the reason that someone's willing to give more money or more basis points is because there's less risk that all of the top people in the company are just going to walk away, because there's usually going to be impact to profit if they do.
And Ryan, the other point is this: by locking up your employees before you're in an acquisition mode, you also increase the likelihood of success. And because, as you're probably aware, probably close to 60% of the deals that go to LOI do not close. And a percentage of those deals are that you haven't locked up your key employees, the acquirer wants this key employee, and the key employee now knows he's got you over the barrel, and either interposes themselves in the negotiations, which could have negative consequences, or wants more money, or says, if I don't get, I'm leaving, and you can't lock that person in, the acquisition fails. So by locking up your key employees prior to starting the actual exit, you increase your likelihood of success, as well of closing, as well as increasing the potential net proceeds. And one other point I will make is that if you look at these, quote, bonuses that are being paid out to buy the equity, they're really advantage to the owner, because what happens is most of these employees are in a lower tax bracket. So if you bonus out to them money and you say, okay, everything that after the tax number goes back to pay for the stock, well, the payment of the stock, if it's issued by the company, is a non-taxable transaction. So therefore, the CEO owner is maybe reducing his compensation, but he then, by the amount of these bonuses, but he then gets back a larger after-tax amount, which can be distributed to them in the form of a dividend. Yeah. Which is, so you reduce so during this period of time, you can reduce the note is outstanding. You can actually increase the owner's cash flow.
Interesting. I like it. So with the 60% that fail, that of the deals that go, which by the way, that's an astronomical amount, and I wouldn't be surprised that continues to go up with the amount of companies that are going to market over the next few years. But other than some of the key employee issues, I know there's a lot of these different mistakes that you've.
The biggest mistake is, I'll relay a quick story to you that I attended a seminar a couple of years ago, where the head of Blackstone Acquisitions was talking, and he put a question out to the audience and said, when are you going to sell your business? And from the audience, 1 year, 5 years, he says, you're all wrong. You're going to sell it when someone wants to buy it. And so therefore, you always have to be ready for sale. And the biggest reason why deals fail in LOI is not being prepared for due diligence and not being ready. So one of the things I also am a strong believer in is that once you are starting to think about this, spend the time to build your due diligence library and then update it quarterly or semi-annually, because a number of the deals that have failed, that I've seen fail, where due diligence ran long because they weren't prepared. The person who's responsible for the due diligence is usually the owner-entrepreneur, who is usually the principal rainmaker. And what happens when he's spending 3 to 6 months doing due diligence? He's not out there selling. And if he's not out there selling and due diligence runs 3 to 6 months, he blows his projections because he's not getting the revenue figures he says. And either at that point in time, the acquirer comes back and says, hey guy, you haven't made projections. We want to haircut your purchase price.
Mm-hmm. So,
and therefore, and at that point, he's got a real problem. He either accepts it or he walks away knowing he spent a ton on transactional fees and knowing that he's probably hurt the business significantly, because employees don't like to be in an insecure position. And a company that fails on an acquisition may lose employees at that point, and therefore it takes you a period of time to rebuild the business at post-acquisition.
Yeah, I honestly could not agree with you more. You know, with our situation, it's and I want to dive into your due diligence thoughts, but you know, my little 2 cents is, you know, when all of a sudden you have to gather all this, my dad and I had the luxury of being able to kind of volley the leadership back and forth for our employees and the selling and gathering the data, but it is a very intense amount of work because of the requirements and the questions that are being asked of you. So I totally agree that having the ability to do that and not impact operations is huge. But then also the thing is your employees get wigged out. If it's not a normal operation to have that stuff, they're like, why do we need this information? All of a sudden, like, you know, for us, I got a VP of sales who's got 15 employees or salespeople reporting to him, and all of a sudden you're asking for the profitability of your top contracts and like the diversity of the customers, and he's going, why are you doing that? And so that alone is almost more scary as an owner than the actual time it takes to get the information.
Well, I think you've hit the issue is that when you're dealing with the quote employees, not the guys who see beyond a paycheck, acquisitions are scary.
Mm-hmm.
And therefore, it's like typically you see in an LOI, as an example, well, we want to talk to your key personnel. And my comment is, you only talk to, in my LOIs, you will only talk to my key personnel and you will only talk to my customers once you've cleared every one of the other due diligence items. So only if there's a problem with my employee or a customer are you walking away.
Right. So I want to let's dive into your due diligence thoughts and what it consists of, because I think, you know, you've got a couple of the different points in your book that talk about it, but, you know, going through it, you know, feels like a full colonoscopy. I mean, you're going down, man. It is like everything you could think of and more. So I don't know if you can, with a light brushstroke, kind of touch on the different kind of things that need to be ready.
Sure. Obviously, all of your corporate records. If you are a corporation, have you done all your annual minutes? Is your stock registered correctly? I've seen a lot of deals where the stock register isn't right, and they've got stock that's supposedly been redeemed that they don't have, or there's a stockholder that's out there that they haven't talked to in 10 years. And then he comes part of the acquisition, and so your stock records, your corporate records. I also believe you need to do financial statement cleanup. There are certain things that, you know, if you look at your financials, there may be things that you can do to make your financials look better. I had one client who had a very unique way of recognizing revenue, that when they got a purchase order, they recognized the revenue, even though the amount purchased may not generate a profit. And so what they would have is $15 million of sales and $6 million of bad debt write-off, because they were recognizing the profit on the PO, even though they hadn't actually, was no guarantee. And so by changing that, we changed that, and it made financing also easier in the future for them. But the idea of looking at your financial statements. Also, you know, planning is important. You should be doing rolling 2 to 3 year projections out. And again, a lot of this stuff, once you do the corporate records once, it's not that difficult to do the to know you need to do the annual update, or if you only own one annual update.
Mm-hmm.
If you've been updating if you have done the things, looked at your financials, are you presenting things the right way? Do you have the right people in the right places?
Well, and it's the documentation too. But so like I think a lot of entrepreneurs coming from fighting the fight. I mean, I can relate totally where I think actually in your book you called it the doo-doo machine, where you're like you're doing things constantly. But when we sold a couple of our branches or we went through our deal, I mean, you can like a lot of entrepreneurs or business owners can answer all these questions, but it's like, okay, then show me. So then it's like, oh shit, we got to find our employment contracts, find and dig up our contracts with our customers, and then they may or may not be consistent. Where are all of these things? I think that is almost more challenging.
Well, that's what I'm saying by building a library, and it doesn't take once. You've hit the real issue, is that most entrepreneurs spend 99% working in their business and 1% on their business. And the idea here is for some period of time, you need prior to deal, prior to IB, prior to setting price, to have a secured computer where you've created a due diligence library where all of the standard contracts are kept. And then on a quarterly or a semi-annual basis, you review that thing and say, oh, we got a new contract type here. We need to get that in.
Mm-hmm.
And having that discipline will make the sale go a lot smoother, because you just hit the other point, Ryan. Most of the things are in the entrepreneur's head, right?
Mm-hmm.
So if he's doing data dumps to the acquirer and his consultants, what is he not doing? He's not working on the business.
Yep.
So that's why doing the data dump prior to it, so you can, yes, you're going to be tied up a percentage of the time in the acquisition anyway, but to the extent that you have done this planning, at least you can continue to run your business at a reasonable level during the acquisition process until you have to reveal it to the employees.
Oh, it is crazy amounts of work. So like we were a office equipment distributor, so we repped Canon, Lexmark, Samsung, Dell, HP. So it was like reseller agreements, and those update. There was like different discounts and cashbacks that we'd have with that. I mean, you have to like literally prove everything out, and depending on the buyers are usually more sophisticated, so they know what they're asking for too.
Well, and you hit the other when you mentioned the point is, if you start doing this now, before you're in acquisition mode, you say, hey, every quarter or every 6 months, I want you to update your particular section, Mr. Employee. They are not going to think it's out of the ordinary when you're in the due diligence mode.
Mm-hmm.
Because this is part of the new procedures that we're putting in, is that we want to standardize and we want to make sure all the records are good. And this way you don't have to you can keep the number of employees who know what's happening with regard to the acquisition down to a minimum.
Mm-hmm.
And in my opinion, that's a key, because rumors are not a good thing in acquisition mode.
No, and time becomes your worst enemy.
Exactly.
So I want to jump into your mistake number 19, which I thought was really interesting, because it's the financing options and what's available out there. So, I've got a keynote presentation that I've done where I think there's a lot of misperceptions, and so I say this statement that a lot of people think there's two options: one where they bring it to market and they get a big check and then they walk away, or two, they have some long drawn out non-profitable family transition. But there's a plethora of options in between. Can you kind of just give? Well,
let's put it this way: every entrepreneur exits his business in one of 6 ways. He sells it to family, he sells it to management, he sells it to a third party, he becomes an absentee owner, it gets liquidated, or he dies. And if you don't choose one of the first four, the last two become the obvious choice. And within that framework, you have to look at, with management sales, the biggest issue you have to look at is, and this is one of the first questions I ask my clients in looking at when you talk about financing is, okay, Mr. Entrepreneur, if you were drop dead tomorrow, what kind of bank, what is the ability for this company to get bank loans?
Mm-hmm.
And, oh, that good, huh? Well, don't you think that since in probably 70% of the acquisitions, you're going to take back paper from this company that you would like to improve your credit risk now?
Yep.
So that again goes to how important employees are, is how do you improve your credit risk that you're going to get paid once you sell it?
Mm-hmm.
But, some of the financing pieces on sale depend on this one issue of one of the other chapters called the unemployable seller. Because the fact is, earnouts are a wonderful vehicle as long as you are capable of saying this is no longer your baby and someone else is raising your baby, and you may not agree with their decisions, but you have to sit there and say it's their baby now.
Yep.
And so earnouts, and I think a key also in earnouts is they have to be written in a way that it is clear, understandable, and relatively easy to calculate. I've seen some litigation over what does the earnout mean and how is it calculated. It needs to be extremely specific when you get into actual writing of the documents of how the earnout is going to be calculated.
Well, and like making sure that if you're the seller, that you can control your numbers that the earnout is based on. Because I mean, I've heard,
right,
if it's a profitability earnout based on net profit or something, where all of a sudden your quote unquote new boss decides to buy a bunch of new trucks, and that hits your profitability, and you no longer hit your earnout because they decided to do a capex at the end of the quarter.
Well, in fact, I just had one recently where it was going to be a net, and we fought and won to change it to a gross profit because we had a situation where we knew that the seller wasn't going to be very happy, but the fact is they had not spent a lot on infrastructure in the last couple of years, and there was going to be a major hit to EBITDA.
Mm-hmm.
And in this case, it was important to keep this person happy, so we went to a gross profit to avoid them taking as big a hit. In some cases, depending on how much you want to penalize, that would be a case where you would probably lay out in advance saying, hey, you haven't bought computers for any of your staff in 3 years. That's $100,000 that's going to go to EBITDA. You understand that it's going to hit your earnout number.
Yep.
And making sure that that if you're going to do an earnout based on net, that there's either control or at least some understanding of what the G&A increase or decrease is going to be at that point.
Well, and making sure, just a little note on that too, is to not. I've seen people where they play the games where they're not investing in their infrastructure, trying to increase their profits so that way they can get a bigger number because it's a bigger multiplier, or the multiplier has a bigger number because they've been profitable more. But then people look at that stuff and they say it's going to need this much, so they end up paying for it one way or the other.
Well, you also hit another issue that I think that is. S corporations are not the best vehicles for acquisitions, for being sold in some ways, because the problem is if you get an LOI towards at the end of the third quarter and you're not going to close until after the first quarter, I've seen banks go through absolute hysterics because the owner is doing all his tax planning because it's an S corp to minimize their income. They're looking at three quarters are very profitable, and all of a sudden, fourth quarter, the numbers drop like a stone because he's doing tax planning.
Mm-hmm.
And so that's another thing that people have to be concerned, at least consider, is that if you are going to sell in a period that's going to go over your year end, and you are an S or an LLC where you're doing tax planning, you have to consider what that may do to your to the acquirer's financing, because they're looking at 3 quarters and all of a sudden they don't understand why your revenue's dropped or your profitability has dropped dramatically.
Mm-hmm.
And you're doing it for tax planning. And so that's another thing to consider, is that you may have to not do as much tax planning in that year of sale.
Well, and you've kind of touched on this term of tax planning. So I want to kind of get your 2 cents on. So I find that there's a lot of misperceptions out there that tax planning is one bucket. You've got estate planning, which is one bucket, financial planning, which is one bucket, and then like your corporate structures is another bucket. And the reality is it's like one big Rubiks Cube, and that's, you know, some of the problems where we ran into that we could have had a lot more money net because we should have looked at it all holistically. And, you know, tax planning, while you're just doing the normal year end, like you had said, is way different than how, like, what your structure is, you know. And trust, or in estate planning, is not just having a power of attorney and a trust, you know, that someone whipped up for 10 grand. So, like, can you explain, like, how all of these impact, like, the net proceeds as...
Okay. Well, as I said, I think the first thing is that the entrepreneur needs to know what their net proceeds needs to be to achieve whatever their next step is. So that's financial planning comes in, is how much do you need to do whatever you're going to do for the rest of your life, or also within that framework, is this your last rodeo, or are you going to potentially do another deal? Because if you're going to do another deal, part of tax planning, in a sense, is maybe using trusts to take some of the chips off the table, that if the next deal doesn't work, mm-hmm. you have protected them. The idea of also estate planning is a significant issue potentially in family business scenarios, because some of the biggest fights I have ever seen in my practice have been where you have 1 or 2 children in the business and 1 or 2 children out of the business, and daddy decides he's going to leave equal shares to the 4 kids. Mm-hmm. And having non-operating working children in a business and operating children, they have completely different goals. And I have seen families destroyed over that issue. I look at, as part of your estate plan, you should be looking at that if you have family that's not in the business, how you're going to equalize the estate and keep the children out of the business, or how you're going to minimize that in a way that is not going to harm the business. I mean, that's part of the estate planning. Within the estate planning also, though, is with the higher exemptions and so on, estate planning from a tax perspective is less important in some ways. Of it's not what you leave your kids, it's how you leave it to your kids. And the idea is, as an example, that I'm working on a project now with a client, and their biggest assets, they are own vineyards. So their biggest asset is the real estate, but the real estate doesn't generate cash for liquidity purposes for estate taxes. So the idea of doing transfers currently or over time into trusts that will not be subject to tax again for a number of generations makes sense. Mm-hmm. So you have to look at, what are the composition of the assets and how they play in. With regard to tax planning on the sale, you also don't want the tax tail to wag the dog. And we may or may not have a tax bill this year. If we do have a tax bill this year, there may be certain cliffs that could come in at a certain period of time. Setting artificial deadlines for taxes can hurt you in net proceeds because the acquirer knows you have that deadline, and if you have that deadline, they have a lot more control over the transaction.
Mm-hmm.
So you have to integrate the income tax, the long run income tax, short run income tax, the estate tax issues, what you're going to do afterwards. All are part of your financial plan as one. And obviously your corporate structure is important, because I'll give one other piece. In family transactions, if they are not service corps, probably the best and most efficient way to potentially do a buyout of the senior generation is through a corporate redemption and being a C corp, because the first $100,000 of taxable income in a C corp is taxed at $22,000, which is considerably less than taking $100,000 out in excess of your normal income and then giving it to your dad, where you're paying 40% on it. So the idea here is also some tax planning with regard to, so a lot of times in family deals, second generation will buy a small portion of the stock, and then the corporation will redeem the stock at a more favorable tax rate.
Yeah, and I think there's so many different ways, and that's why I love the Rubiks Cube analogy, because depending on what your goal is, you got to back into from the goal. Because I've heard even, horror stories. Actually, I was talking to this gentleman. He's a friend of mine he's got a firm similar to mine down in Texas. Works with a minimum of net worth of $25 million families, and this family's worth like $400 million or something like that, and they sold 60% of his big, huge, they have a retail chain to a trust that all these different tax things, but then all of a sudden the company blew up, did really well, and the dad could not afford to pay the tax bill, even though his kids got rich because they were the beneficiaries of this trust.
Well, yeah, and that's another point that I'm going to make to you, is that clients need that the choice of your business entity will affect the type of trust that you use. Mm-hmm. Because GRATs, the grant to retain interest trusts, are okay for S corps and LLCs, and the owner they work, because what happens is you make the gift and you get the appreciation out, but the senior generation is paying the income taxes. But if you have a C corp that is only going to have, and the reason why that's important is that a trust reaches the top tax bracket at about $14,000 of ordinary income. So you do not want a lot of ordinary income running through an irrevocable trust. So flow-through entities don't work with irrevocable trusts, unless they're GRATs or other types of grant or retain interest trusts, where the grantor is willing to pay the taxes. On the other side of the coin is, if you have a C corporation, then why would you ever use a GRAT? You would, because an irrevocable trust gets the same favorable capital gains treatment as an individual. So why would you want the grantor to pay capital gains taxes on the sales proceeds, when that could be paid by the trust at the same rate?
Yeah, it's just one big, huge jigsaw puzzle.
Well, and here's another thing that I think people should also consider is, in some cases, the entrepreneur is still supporting the parents. Is now supporting the parents. Mm-hmm. And one of the things that I've been using recently is setting up the selling, making a contribution to a charitable remainder trust for the benefit of parents to supplement their income, and getting a significant charitable deduction to reduce the tax liability in the year of sale.
Yep. There's just so many, and that's that. This is a huge, long technical rabbit hole that I know that you and I could probably volley back and forth for a long time. And I think, the biggest takeaway is, it is so intertwined, and it all has to do with your goals, your timing. And even like I think you've alluded to in your book, where depending on whether you sell, like, of one of the 6 ways, each way that you're planning on exiting will determine all the ways that you back in technically from this. So I think making sure that you understand the correlation between your exit options and goals versus all this technical stuff.
Ryan, let me add 2 quick points to what you just said. One is, while I said there's 6 ways to sell your business, the best way to sell your business is when you're an absentee owner.
Mm-hmm.
So you should be, that every entrepreneur should be striving to be an absentee owner, because that's when the business is most valuable, because the one thing that's going to happen after the acquisition generally is the owner isn't going to be there.
Yep.
So striving to become an absentee owner. And the other thing that I raise is that you have to make sure that your professionals, the problem today with large firms is that large firms have become highly specialized. And with that high specialization, one of 2 things happen. Either you either have 5 different partners who are going to have to learn about your transaction to make sure it's all covered, or something's going to get missed. And that's why
Yep.
And that's why it's really important to have someone who is going to be the quarterback and make sure that the right people are involved at the right time.
Yep.
And that's where the value add is to make sure that you have the right people in the right place, and the right questions are being answered.
Well, and that's, I sat in that exact position, right, where we had a CPA from a large firm in town, we had an attorney from a large firm in town, and, as an entrepreneur who was like, yeah, we know how to sell the hell out of IT services, office equipment, all that stuff. You sit across from all these suits thinking that they should know all this stuff, and you don't realize that your attorney isn't specialized in M&A, that they're actually specialized in employment law.
Right, exactly. And the thing is, or you've worked with the same attorney for 30 years, and he's a great attorney, but he's not an M&A specialist.
Oh, it's such a huge deal.
If this is the biggest sale in your life other than real estate, you need to have someone who actually knows how these deals run.
Well, and knows how, knows how they run. And the interesting comment that I heard from the gentleman Todd Ganos, who was on our show back in like January or so, he said it impacts the continuing ed. So if you're a CPA that doesn't do M&A for a living, why would you stay up on all of the stuff that we talked about? Because it's not important, because you've only done 1 in your entire life versus the person that's done 10 this year. Right,
exactly.
So as we're kind of running low on time here, I was just you hit on a huge thing, because I was actually going to ask it to you, and I think you already answered it, which is striving to be the absentee owner. If most entrepreneurs are in the the doo-doo machine where they're doing, which is 90% of the time, and they're only working on the business 1% of the time, striving to be the absentee owner should be their goal, right? So,
yep. And there are let me say there are a couple of first off is this: if you don't do that, you become the biggest backup in the business.
Mm-hmm.
And if you are the biggest backup in the business, what ends up happening? Those that are entrepreneurial, if the entrepreneur has to make every decision, you're going to alienate those people in your management team who have entrepreneurial spirit, because they're going to figure they can't make any decisions, and all you're going to end up with is yes men in management, and therefore if you're not there, the business falls apart.
Well, yeah, and I think it's like the best gift on earth, which is your sole goal is to work yourself out of a job, and
Exactly.
and your company's worth more because you did it.
Exactly.
And that's I don't know if you're familiar with the book Snowball by Warren Buffett.
Yes.
So, I mean, that's what Warren does. That's what Berkshire Hathaway is, right? He goes in there, he understands it, and then he delegates until all he has to do is read the financials.
Yep.
So,
Agreed.
as we're, I don't know if there's anything we haven't covered that you want to make sure that, we reiterate, or is one thing you want to highlight before we kind of wrap up?
I think the reiteration is this needs to be planned. You can't, if you wait and just say, okay, and then someone comes to you with an LOI, you're going to get a lot less proceeds. And as I analogize in one of the statements I make to clients is, until you get the LOI, you are like the prom queen and everyone wants to date you. The minute you sign the LOI, the shoe is on the other foot, and the acquirer will do everything they can to potentially reduce the price.
Yep.
And so you need to make sure that when you do the LOI, that you've got someone. If I see a 2-page LOI, I'm concerned. An LOI needs to specify, and also another point within that specification. I'm a big believer that if you have a formula that's been used to calculate the quote purchase price, that you use the formula in the LOI. This way, in case there is something that hiccups in due diligence regarding revenue, the deal you don't get into a fight at that point over what the new number is. Mm-hmm. Is that to the extent you can be as specific as you can build things that have flexibility with regard to where the deal can fall apart in the LOI, you have a larger chance of taking the LOI to closing if it's built as a flexible document but detailed.
Great advice. Absolutely love it. So, Stuart, what is the best way our listeners can get in touch with you?
Well, they can contact me through my website, which is stuartsorkin.com, or they can reach me by email at ssorkin@shspc.com.
Stuart, thank you so much for coming on the show.
My pleasure.